I think the markets are being too aggressive in pricing in a Fed rate hike over next summer. I think the Fed is going to keep tapering its bond purchases. By June 15th. They will be down to zero. And I think that's what they intend to do. But I think at that point, they will sit on their hands for the rest of the year, because by this time next year, the economy will be growing more slowly in the United States. I think it'll speed up and then slow down again. I think inflation will be down because a lot of supply chain issues have been resolved. And the Federal Reserve really doesn't want to raise interest rates before the midterm elections in the United States in early November. And so that would suggest that maybe they do put in a rate hike next year. I think they will. But I think that'll be in December of next year, not in September or any earlier than that.
And when would that slowdown that you're anticipating next year catch up with the markets? Because a large part of, obviously, the euphoria that we're seeing right now is because earnings have looked good, growth momentum still seems to be strong, employment numbers are improving, and the Fed is also saying that economic activity is quite brisk.
Well, yes, but it's really not just the market reading the economy. I mean, it seems like any economic report, any earnings report comes out, it just pushes the U.S. market higher. And what's really going on is that all the liquidity that central banks have poured into global financial markets have pushed interest rates down to such low levels that people are looking for return elsewhere. And that's funneling money towards global equity markets, particularly the U.S. equity market, and pushing it higher. So to some extent, when you get a correction, it's not necessarily when the fundamentals change, but it's when there are better alternatives for total return out there. So we'll be watching, obviously, long-term interest rates very carefully. If long-term interest rates move up, even as the Federal Reserve tapers here, then you could see a bit of a movement towards a fixed income from equities, and that could be the thing that triggers a bit of a correction in markets. But certainly the U.S. equity market is overdue for a correction, but it's hard to see. It's a little unrelated to fundamentals at this stage. I think we need to see something slowing down the liquidity going into the market.